warmth of your skin. I feel the touch of your hand. Love you with all of my heart.
Hey guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So you want to buy one of those really big homes, $4 million plus, 90% loan to value. Too good to be true? No. Well, we have something that is called an alt-doc program, an alternative documentation program. Now, this program is ideal for people who don't qualify off of traditional method lending practices. This is like, well, because mainly it's we have a threshold of how high we could actually go as far as what we are able to get qualified for. Certain counties have certain limits. Freddie Mac, Fannie Mae will set their limits where it comes to the jumbo. FHA has their limits. Everybody has a limit of where they could go ahead and fund to. So we have these alternative documentation programs, these mortgage programs that allow us to go ahead and get people approved that want to go ahead and go up to that higher 3, 4, and in some programs, with some programs that could go all the way up to 10 million, depending on the property type and what it's zoned for, and you know, every one of these properties is a little funky. But let's go ahead and dive deep into this alt-doc program, and we'll go from there. So asset depletion. What's asset depletion? Asset depletion just means like how much money do you have on hand, liquid assets that you have, and it could also be your properties or anything like that. And how much is that worth? Are your properties paid off? How much is left on it? How much money do you have liquid in your account? That will go ahead and be what's called an asset depletion. We'll go ahead and deplete the assets. Not deplete the assets, but we will deplete the assets as far as on paper. We'll go ahead and, you know, take it divided by 360, because 360 is a 30-year period, and then we kind of get where your mortgage rate is going to be. So for instance, if you have, I don't know, like $1 million in your account, right? After your down payment and all that other jazz, let's just say for the sake of argument, you put 20% down, you have $800,000 left. We take that 800,000, divide that by 360, that 360, then that'll give us our threshold for our monthly mortgage principal, interest, taxes, and insurance. That's pretty. That's pretty. And well, that's just one of them. Now we could go many other ways around it. So for this program, asset depletion is one of them. If you're also a business owner and you're surpassing the threshold because your business is doing awesome and you're trying to buy, I don't know, the Playboy Mansion or something, which I don't think that's $4 million. I think it's probably a lot more. Or could it be? I wonder if you ever bought the Playboy Mansion if it comes with the girls. That'd be worth more or less. I guess that's relative, isn't it? Depends on who it is. Whatever. Okay. So back onto the program itself. So if you really have a situation where you want to go that high, just go ahead and message us exactly your scenario. Link in the description below. I'll go ahead and help you out, because everybody's situation is so different that it's kind of hard to categorize every single person in this. Like, okay, so you have a plumbing business that does this and this and this, and then you have this much capital investments in your stock, or you have crypto guys. The crypto guys is another one of these that do these alternative documentation programs, because you have, I don't know, millions of coins out there and you're kind of riding this crazy tidal wave. You're buying them, selling them, pulling them back. I don't know, whatever it is that you guys do. Whatever it is pretty impressive. So as far as the program is concerned, these are people who cannot qualify normal traditional methods. Now, whenever we are looking for these non-traditional methods, right, we look at something that, and you'll hear it quite a bit. It's called ATR. ATR, I don't know why they try to get all fancy with it. I don't know why any of us get all fancy. Oh yeah, the ATR. ATR just means ability to repay. Just, can you pay it back or not? So on the asset depletion is the only part of this alternate documentation loan program. And of course, asset depletion, we already went over it. That's the only one that you could actually go down to a 660 credit score. This is actually could go all the way to a 90% loan to value, which we already mentioned. So this loan program, this could actually be, so when we talk about the 90%, right, loan to value, that just means that you're only putting 10% down, right? Because we are 90% loan to value. It also, you know, the properties also change, okay? So just remember that, like, if you're thinking like, okay, I could go ahead and buy this property. We're talking about just turnkey properties, okay? If you're looking at something that you're trying to project the ARV, which is your after repair value on a house that needs a little bit of fixing up, a little bit of sprucing up, and we're going to go ahead and get you a little bit of more cash flow to go ahead and fix that guy. It all changes. Everything changes. So, but the spark note of this whole entire thing, the little base, the foundation of this, well, you on a rate and term, which is like rate and term. Rate and term just means it's a rate and then the term of the loan. For a purchase, you could do a refinance on this too if you want to go ahead and pull anything out. You could go all the way up to the 90% loan to value. So let's say your ARV when you first bought it was like at 80%. Afterwards, your after repair value just shot up and now you are like a 60 loan to value. You could go all the way to 90% loan to value and pull that extra bit of cash out, which you Burr method guys, you investor guys, you whatever the hell you want to call it nowadays, these guys, this is how it's done, right? You go ahead and take a crappy property, pay $100,000 for it, you fix it up, now it's worth $200,000, and then you take your money out of it, and then you go ahead and do it all over again, and you just run this vicious cycle, which that's what we do. So this loan program itself, okay, so how much can you get? Like we stated already, you could get up to $4 million, but how much cash out can you do? You could do the max cash out on this loan program that you could do is $2 million. I don't know about you, but I think you pretty much buy Kentucky with $2 million. That's a lot of money that you could go ahead and pull out. That's a shit ton. Now there is something that's called reserves, okay? You do need 6 months worth of reserves in this program. Now what is a reserve? A reserve, so after you go ahead and subtract the amount that you have for your down payment and your settlement costs, which is your closing costs where you have to pay title, escrow, you have to do any origination, underwriting fee or whatever it is, or maybe even taking a higher rate to kind of compensate for the closing costs. If you are trying to go, and then after all of those closing costs are all out of the way and they're completely done, then what we have is reserves. So let's say hypothetically your mortgage, principal, interest, tax, and insurance is $2,000, right? So for that $2,000, you have to have 6 months worth of reserves in your account separate from whatever it is that you're putting down on the property. So the reserves on that would be $12,000 because 6 times 2 is 12,000. I did that all in my head. So proud of myself. Hold on, Carrie. I'm just kidding. Now your next question is probably going to be like, hey Omar, so can this be on an investment property? Nope, this will only be on your primary residence, or it's going to be on a second home. Let's say you and the missus or the mistress or whatever your lifestyle has, you have to go ahead and buy a second house. You could go ahead and buy that guy in conjunction to the primary that you have. You could do either or. You could have two simultaneously. I don't care how you do it, but it could only be on a primary and it could be on a second home. Is there interest-only options on this, Omar? Yes, there is. Interest-only options are available on this, which seems to be like a lot of investors like the interest-only. Now, the second home, even though I just said that no, it's not for investments, but your second home, you are able to go ahead and rent it out. You could do an Airbnb if you want. You could do whatever you want. So it kind of sounds like an investment, but whenever you have a second home stipulations just mean that you have to live in it 6 months out of the year. That's all it is. The other 6 months, you could do whatever your little heart desires that you want to do. Somebody going to be knocking on your door to check? Probably not. But I gotta tell you that it's 6 months. 6 months you gotta be there. 6 months you gotta be out, or you can do whatever it is that you gotta do. Once you get in the loan program and you qualify, it's your house. Just do whatever your little heart desires. Now, as far as the calculations go, as far as your debt to income, right? Now, depending on if you're a self-employed or W-2, 1099, whatever you are, right? Your total income from your debt to income ratio. That means that after you paid everybody out, and we're not talking about your gross or your net, we're talking about your gross, okay? Or your gross. So like before like, you know, all the taxes and everything like that, how much you actually bring in. Except if you are self-employed, you have to look at your P&L. On your P&L, then you'll go down and you'll see what your income is after all your scheduled losses are. That'll be your total income. So as far as that number goes, it could only be 50% debt to income. So what I want you to do is I want you to go and take all the bills that you have, put them all together, take the mortgage and principal, interest, tax, and insurance. You're gonna take that guy and you're gonna slam dunk that bitch, bam, you're gonna put that guy right in there too. And then if that is equal to 50% of the total debt that you are trying to go ahead and compare to your income, then that's where you're at. So you got your 1099s, you got your W-2s. On this program, you only need 1 year tax statement, so you don't have to get all crazy with that either. And that's pretty much in a nutshell an alt documentation mortgage. I might be forgetting some other stuff, but if you do have any additional questions, please note, link in the description below for any mortgaging assistance, for up to 50% commission rebate on your next real estate purchase, and for 0% listing fee. We do have that option available. Of course, we do have ones where we do straight commission, depending on how you like to do it, because you know what? In the world of real estate, commissions are negotiable. Do I negotiate anything out of my threshold? Absolutely not. Go on to the next one. I don't feel like negotiating. I have my program. This is what I have. This is what we go ahead and offer. If you like it, great. If you don't like it, then by all means go to, I don't know, go to the other guys. But we do offer 0% listing fees on our listings. We have, as you could tell from the massive amount of mortgage programs that we go ahead and display to you, or at least I do, and I get this information out to you. We have a lot, and 50% commission rebate. Sheesh. You get yourself, I don't know, 2 mistresses in your second home. I don't know why I just gotta stop making these lame jokes. God, I'm so lame. But if you like the content, please consider liking, subscribing, doing all that good jazz, comment, whether you like it, dislike it, I don't really care, but just do something. Do something down there. Till next video, guys.